Hey everyone, this week I'm focusing on the third quarter fundamentals for retail and industrial properties. And I'll start with the big picture for retail. In the third quarter, the retail vacancy rate remained stable at 4.5% with 2.7 million square feet of net absorption. Now, that absorption number may sound minuscule, but this really boils down to the lack of available space. The overall retail vacancy rate, including multi-tenant and single-tenant retail properties, has been hovering between 4.4 and 4.6% for 10 quarters straight. Basically, since we've come out of the pandemic. And although we all see the stories about retailers going out of business and shuttering locations, I'm generally hearing that there's usually a line out the door waiting to get that vacated space. The exception, of course, is space in the older, underperforming enclosed shopping malls. That's where a lot of the vacant retail space is concentrated. If you look at just the open air, multi-tenant retail centers, the national vacancy rate's in the low 4% range. And historically speaking, that's about the lowest it's ever been. There's always a little bit of churn in the retail inventory, so getting the open air retail vacancy rate below 4% on a macro level is really hard. But even though there's been pretty steady rent growth for the last 4 years, the pace of rent growth remains relatively modest. Over those 4 years of tightening vacancy, rent growth has averaged about 3.3% per year, and in the third quarter of this year, it was 2.5%. But several retail property owners I've spoken with have told me they're getting stronger bumps on new leases and existing tenants are stepping up to higher rates on renewal. But I'm also hearing that the current lease rates still aren't high enough for new development to pencil. So we're only seeing about 30 million square feet of new space in 2024, and of that, about 3/4 is single tenant space being constructed for specific tenants. So new supply risk for investors is minimal. As far as local markets go, the momentum has generally been broad-based. Markets with stronger in-migration, areas like Florida, Texas, Charlotte, and Nashville have been doing very well. But we're also seeing strength in markets like Indianapolis, Salt Lake City, and northern New Jersey, where vacancy rates are in the low 3% range and rent growth has been particularly strong. And barring a major economic setback, the retail property outlook remains solid with minimal construction, consistently low vacancy rates, and modestly rising rent growth. And the retail sector momentum has benefited industrial properties. The strength of retail, especially e-commerce, over the last few years really bolstered industrial space demand. But the pace of space absorption has tapered over the last 2 years, and builders have been adding industrial warehouses at a record pace. In 2023, a record 517 million square feet of industrial space was added, dramatically outpacing the 153 million square feet of absorption, and that lifted the vacancy rate substantively. That story carried into the third quarter as nearly 54 million square feet was completed, outpacing the 22 million square feet of net absorption in the quarter. That has lifted the industrial vacancy rate by 20 basis points to 6.6%. That's the highest national average industrial vacancy rate since the third quarter of 2014, 10 years ago. To go with that, average asking rents have tapered over the last couple years, and in the third quarter, they were down by 0.4% on a year-over-year basis. The good news for investors is that the pace of construction is slowing, with about 315 million square feet expected in 2024 and only about 210 million square feet anticipated in 2025. At the same time, consumption remains robust and e-commerce sales have continued to track higher. So, if industrial development continues to slow, the supply overhang should be absorbed in a couple years, as long as retail sales remain healthy. From a local market perspective, metros with outsized development like Atlanta, Austin, Charleston, Dallas, and Phoenix faced the greatest short-term headwinds, while areas with more limited inventory growth like Chicago, Cincinnati, Louisville, and Minneapolis likely offer more durability. So, as I look forward for both retail and industrial, construction will be key. The virtually non-existent retail construction and slowing pace of industrial construction will be key factors driving the performance. But we still have a lot of variables in play. Retail sales growth on an inflation-adjusted basis has flattened, and the consumption outlook will be influenced by interest rates, job creation, wage growth, and consumer sentiment. And those variables will likely be a bit choppy for the next few months, which is why investors always need to keep their eyes on the horizon.